Investors punished Westpac today. Third quarter profit missed the mark and the outlook for the rest of the year was cautious. Revenue and margins were also down, although the bank says the margin decline is slowing. Andrew Robertson reports.
Westpac's unaudited quarterly profit of $1.4 billion was up 27%, but still about $100 million less than analysts were expecting.
But this has been a solid quarter and one that I'm happy with. I believe we are dealing to a challenging environment very well.
But not well enough to keep investors happy, with Platypus Asset Management's Don Williams among those to describe the result as disappointing. Profit growth was almost entirely driven by a fall in provisions for bad and doubtful debts, reflecting the improved economy. Revenue was down, although Don Williams accepts trading conditions for banks are less than ideal.
Credit growth is anemic at the moment. It's still around 2%. And that's going to take some time to improve. So that's the key driver. That's why revenue growth is so muted at the moment. And the other side is the funding costs are still a problem for all the banks. They're rolling into higher cost funding, and that's putting the pressure on margins.
Net interest margin, which is the difference between borrowing costs and lending income, was down again in the quarter to 2.17%, although Gail Kelly says the pace of decline is slowing. Morningstar's head of equity research, Peter Warnes, says that fall in margins is a direct result of Westpac's aggressive push into the first homeowners market.
Longer term, once that big portfolio of mortgages is repriced, it'll be a different story. But in the short term, there's going to be some pressure on that net interest income line.
Repriced is code for raising home loan interest rates outside Reserve Bank movements, something Peter Warnes believes is a certainty.
Yes, they'll have to recover the increasing cost of wholesale funding.
Business lending also had a tough quarter. Institutional business was off nearly $3 billion, with more than half that relating to property, something Gail Kelly put down to de-gearing. It was partially offset by an improved performance in commercial and SME lending, which includes St George Bank.
That part of the business peaked some quarters ago, and all the banks, with the possible exception of ANZ, are suffering the same fate on that side of the business. And there's still pressure there as well.
Morningstar's Peter Warnes has a different view and thinks there's a warning for the whole banking community in Westpac's decline in business lending. Many firms felt they got a raw deal from their banks during the global financial crisis, and Peter Warnes says the increasing use of the bond market to raise funds by companies such as Orica, Telstra and AGL, to name a few, is payback.
The CFOs of these big corporates have to look at their debt profiles and how they fund, growth opportunities. And if, in fact, they're going to get legged over by banks, then they're going to go to a safer and a more certain debt profile where they don't have to talk to the banking community.
Which, if that's true, does not augur well for an outlook Westpac boss Gail Kelly already thinks is less than rosy.
There's still many uncertainties and risks, particularly with continuing troubles in Europe and signs of slowing activity in other developed nations. And so as a result, I think we can expect both lower growth and higher volatility to persist for some time yet.
A statement which contributed as much as anything to the nearly 3% fall in Westpac's share price.